efficiencies and synergies and synergies and synergies like this, and synergies and synergies and synergies and synergies and synergies that usually motivate mergers, that usually motivates mergers and acquisitions, that usually motivates mergers and acquisitions, mergers and acquisitions, that usually motivates mergers and acquisitions, full stop, that usually motivates mergers and acquisitions, full stop, full stop. Then you say it involves combining, it involves combining the original social technical systems. It involves combining the original social technical systems of the merging organizations into one newly combined system, into one newly combined system, into one newly combined system. It involves combining the original social technical systems of the merging organizations into one newly combined system, into one newly combined system, into one newly combined system. So that's what we mean by post-merger. So simply is what happens after the merger, how the organization will likely be able to integrate. For example, the social technical systems, what you're talking about, for example, the human resource of the two companies that have come together, they have been used to basically two different cultural systems. So after merging, you have to basically unify the cultural systems of the two companies. So the second question basically talks about, discuss 4 types of post-merger integration. So you can actually be able to mention them and be able to define them. So the first way of how they can be able to integrate, we can be able to say, number 1, so you can have what we call preservation. We have preservation. We can have preservation. Number 2, we can have what we call holding. We can have holding. Then we can have what we call symbiosis. Symbiosis. Then the last one, you can have what we call absorption. 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 So these are the 4 types of post-merger integration that we can actually be able to have, or how organizations can actually integrate after the merger. So the first one, we have preservation. You can be able to define and say, it is where the target company, is preserved. It is where the target company is preserved. The target company is preserved. It is where the target company is preserved. It is preserved and left autonomous. It is where the target company is preserved and left, you can say, and left to operate autonomous, and left to operate autonomous or independently, and left to operate, and left to operate autonomous or independently, and left to operate autonomous or independently. Then we say full stop and say, only the financial reporting and financial processes, only the financial reporting and processes are integrated. Only the financial reporting, only the financial reporting, only the financial reporting, only the financial reporting and financial processes are integrated, are integrated, are integrated, are integrated. So that is what we mean by preservation. So it is simply whereby the acquiring entity acquires the target company or the subsidiary, but now it is left to operate independently. For example, in this case, they don't basically maybe do away with the name of that particular company. It will still basically operate with its name, but of course it has already been acquired by the acquirer or maybe by the company it is actually merging with. So it will be left to operate independently. But when they are doing the financial reporting or basically reporting their books of accounts, they'll be able to ensure that they have actually been able to integrate or prepare what we call consolidated financial statements. So that's what we mean by preservation. So the target company is simply preserved to operate autonomous even with its name, but already it has actually been acquired by the holding company or basically the acquirer or the company that is simply acquiring that particular target company. Holding, so you can be able to define what is holding. It is where the acquiring company, it is where the acquiring company holding, it is where the acquiring company only keeps the ownership of the target company. It is where the acquiring company only keeps the ownership of the target company. It is where the acquiring company only keeps the ownership of the target company, but does not integrate the target company, It is where the acquiring company only keeps the ownership of the target company, but does not integrate the target company, Then we have symbiosis, another type of post-merger integration. It is where the integration is done systematically. It is where the integration is done systematically. It is where the integration is done systematically. It is done systematically. It is where the integration is done systematically. It is where the integration is done systematically to reach the objectives of the merger, to reach the objectives of the merger, to reach the objectives of the merger. It is where the integration is done systematically to reach the objectives of the merger or to achieve the objectives of the merger, to achieve the objectives of the merger. It is where the integration is done systematically to achieve the objectives of the merger. So you do it systematically. For example, department by department. So you merge this particular department this month, next month you go to another one, or maybe you merge those areas you think that are actually quite necessary for the operations of the two companies as merged entities. Maybe you don't merge certain departments, you leave them to operate in that other company. So you do it systematically. This department, the other department next month, like that. So you do it in a process known as symbiosis. So you do it systematically just to achieve the main objective as to why the two companies have actually been able to integrate. So we have the last one, which is absorption. So under absorption, what actually happens? The acquiring company fully absorbs. The acquiring company fully absorbs. The acquiring company fully absorbs. The acquiring company fully absorbs the target company. The acquiring company fully absorbs the target company, fully absorbs the target company. The acquiring company fully absorbs. The acquiring company fully absorbs the target company. 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 Full stop. All the processes are integrated. All the processes are integrated. All the processes are integrated, All the processes are integrated. All the processes are integrated. So it is where simply the absorption is done fully. So in this case, for example, when you talk about Quickmart, Tumaini supermarkets, So this one is fully absorbed by this one. So it loses its identity. So the supermarket is simply known as Quickmart. So once it acquires Tumaini, all the processes are actually integrated and it is taken as being Quickmart or this particular supermarket. The identity is actually lost. So all the processes of Tumaini will be integrated into Quickmart. So that's what we mean by merger or post-merger integration process known as absorption. So those are the types of post-merger integration that we can actually be able to have. So you can look at another one. You can look at another question. So this is part 2 of what we are looking at. So number you can be able to say, what are the benefits? What are the benefits of corporate restructuring? What are the benefits of corporate restructuring? What are the benefits of corporate restructuring? Part B, you can be able to say part B, Roman 1, and say, define the term reverse merger. Define the term reverse merger and state its advantages Define the term reverse merger and state its advantages. Roman 2, define the term amalgamation. Define the term amalgamation. So what are the benefits of having to do what we call corporate restructuring? So corporate restructuring is simply said, it is a process under which a company will change its form of operations or its business operations or how it operates as a business. So maybe it can be able to look for external means of actually being able to restructure or change form of operations, or maybe it can do it internally, for example, by being able to merge some of the departments. So whereby the company changes or alters its processes or business processes, we say the company has actually been able to restructure. So when you talk about external means, for example, having to go to merge with another company, it can be able to use that particular process as a means of restructuring. Alternatively, you can actually be able to talk about having to be acquired by another organization. So that is actually a means of actually having to restructure or change the form of operations. So most companies will actually be able to restructure, maybe to continue to survive in business, or maybe to continue to operate, or maybe to avoid having to be liquidated. So sometimes those means of restructuring, we can actually be able to call them alternatives to winding up. So sometimes they could ask you, state 4 alternatives to winding up of a company. How can the company be able to avoid what we call having to be liquidated or basically being wound up? So they can be able to use means of restructuring or methods of restructuring or types of restructuring as a means of actually avoiding to be liquidated. So if they ask such kind of a question, you simply say, for example, mergers. You simply say, for example, what we talked about, compromises and schemes of arrangement as a means of actually avoiding to be liquidated. You can talk about, for example, having to be acquired. You can be able to talk about something like, for example, reverse merger. So those methods of restructuring can be alternatives for the companies to be able to avoid what we call liquidation or being wound up. For example, if you as a company, you are not performing so well, you are actually better off having to be acquired with a company that has the financial strength or muscles for you to be able to continue to operate. Because if you continue operating independently, basically you won't actually be able to meet your obligations, and most probably you can actually be liquidated. So if you have another company that can actually be able to invest in you as a company or put in resources into you as a company, you are better off actually being acquired or actually having to merge with another company to continue to survive in that particular industry, which might actually be very competitive. So that is what we mean by corporate restructuring, changing form of business or how the company is actually operating. It can happen internally, or the company can actually be able to go for an external means. So what are the benefits? What are the reasons that can actually be able to make a company to ensure that, or basically to go for what we are calling corporate restructuring. So number one, we can actually be able to talk about to reduce costs. To reduce costs is the first point, to reduce costs. To reduce costs. For example, if they merge departments and do away with some of the staffs, it basically means that the company is restructuring or changing its form of business operations to be able to reduce on its costs. Number two, to concentrate on the key products of the company, to concentrate on the key products of the company, to concentrate on the key products of the company, key products of the company, to concentrate on the key products of the company. So this basically can actually be through what we call a means of restructuring known as divestiture. Divestiture. So divestiture is actually another way of restructuring, or a type of restructuring, or the options a company can be able to use to be able to restructure. When you talk about divestiture, so it is simply whereby the company does away with a product, or basically assets that are normally utilized in production of a particular product, which is not performing in the company. So the best example I normally give is, for example, if you have two companies, we have East African Breweries Limited, and you have another company known as Coca-Cola. So this particular company, it is best known for producing alcoholic products. This one is actually best known for producing soft drinks. So if this particular company, and I think there's a time it had a product that basically, I don't know if it is still there, the product that basically was a soft drink product. I think it was Alvaro. So Alvaro, so sometimes they say it has alcoholic content. I don't know if it is actually true. So this particular product is a soft drink product, and therefore the main business, or basically the main products of the company, are actually alcoholic products. So you might actually be able to realize that this company is not making enough profits, or even this particular product is actually operating, or this particular segment of a product is basically operating at a loss. It is basically being maintained or sustained by the alcoholic products because they're actually very profitable. So if the company realizes that this particular product is making a loss as a segment of the products in the company, it can actually be able to divest it. How do they divest it? They sell this particular product to Coca-Cola. If they do such, we say the company has actually been able to divest, or do what we call divestiture. So therefore, they'll be able to concentrate on the key products of the company, which are actually alcoholic products. That is what we mean by divestiture. Number three, advantage or benefit of doing corporate restructuring, you can actually be able to say to incorporate new technology, to incorporate new technology. So number three, to incorporate new technology, to incorporate new technology. Incorporate new technology. Incorporate new technology. So maybe there's a new technology that has actually come in. So they have to change how they basically carry out their business. So in the banking sector, technology has actually really taken over. So for example, nowadays we have ATMs that you can actually be able to use to deposit money. This simply means that you can actually also be able to access money on your phone. Is there a need of a teller at the bank? There's no need of a teller at the bank. So therefore, the bank will restructure by doing away with some of the tellers. Maybe they just need like one teller in a branch. If they do such, we say they're incorporating in new technology as they restructure. Because if money can be accessed by the customer on the phone, so what is the need of the teller actually being there? So if there's new technology that is being incorporated, most probably the company will actually be able to restructure. It will restructure. Number four, to make better use of talent, to make better use of talent in the company, to make better use of talent in the company, to make better use of talent in the company. So maybe we have like an auditing firm. So the auditing firm basically provides services to do with bookkeeping, auditing, financial advisory. So you discover that these particular staffs who are doing auditing, they could actually be able to also do what we call bookkeeping. So what you do, you basically combine the two departments. you utilize the human resource you have or the talent you have appropriately by simply being able to restructure and saying, instead of having two different departments of bookkeeping and, for example, maybe auditing, you combine the two and have auditing and bookkeeping departments. So you'll actually be able to utilize the talent, because these persons who are doing auditing, they have the expertise also in carrying out bookkeeping. So if you do such, we say you have actually been able to restructure so that you can actually be able to utilize the talent you have in the company appropriately. The next one, you can actually be able to say to improve or remain competitive in the industry the company is operating in, or to remain competitive, you can just simply say to remain, so as to remain competitive, so as to remain competitive, so as to remain competitive. So number 5, so as to remain competitive in the industry the company is operating in the industry the company is operating in. So to remain competitive in the industry the company is actually operating in, so they can actually be able to restructure. So maybe to avoid competition, you basically opt to merge with another company in the same industry so that you can actually be able to remain competitive. So the best example you can actually be able to give is the telecommunication industry. We have Safaricom, Telcom, and Airtel. You know the giant in that particular industry. The giant in that particular industry is Safaricom. So for Telecom to remain competitive, they could opt to basically merge or actually come together with Airtel. So I think that particular merger was to happen, but it was actually declined by the telecommunication, the regulator of the telecommunication industry. So if they actually merge, then they can actually be able to have a competitive advantage maybe over Safaricom, so which basically controls a huge percentage of that particular industry. So as to remain competitive, Telecom could actually opt to merge with Airtel, so that they can actually be able to remain competitive in the industry they're actually operating in. So those are the advantages or basically reasons or benefits that as to why the company could actually be able to decide it is going to restructure or do what we call corporate restructuring. So under corporate restructuring, I think we learned about, we defined it. Of course, we defined it. We learned about mergers. We learned about acquisitions. So there's something we learned about how to avoid a hostile takeover. So this one has been tested several times. I don't know, I think it was in the last sitting. I don't know if they'll be able, what are the chances they'll actually be able to repeat such kind of a question, but it's important you just know it. How to avoid a hostile takeover. They like testing this one. So if you check in your notes, it's the last bit of your notes, how the target company can actually be able to avoid a hostile or an unfriendly takeover by the acquirer. So the acquirer, because under mergers or under acquisitions, we say we have two companies. We have the acquirer and we have the acquiree, or the target company, or the target company. I think we learned about the procedure of having to do an acquisition or a takeover. So it's important you go through the notes and actually just understand it briefly. So for example, we say that the acquirer, so sometimes if it is a hostile takeover, we say this one is a predator. It is a predator, and this other one is the target company. The one that is being acquired is the target company. So what normally happens is that acquisitions of companies is regulated by, or acquisitions in Kenya actually, acquisitions and takeovers are regulated by the Capital Market Authority Act. So that's basically the act or the law that actually basically regulates on how an acquisition can actually be able to happen in Kenya. For example, if you have Safaricom wanting to acquire, for example, Airtel, they'll be able to follow the provisions under the Capital Market Authority Act. So we say the acquirer comes out publicly and actually clearly indicates that he has the intentions of having to acquire the target company. Then he makes his presentations to the Capital Market Authority and also to the Nairobi Securities Exchange. So once they have done that, of course, what will happen now, the acquirer or the company acquiring the target company will actually be able to make that particular acquisition proposal to the target company. So they'll actually be able to now present that particular proposal of the intention to acquire the target company. So they present to them their proposals, the reasons as to why they want to acquire them, and what are the advantages they are bringing on board if they're actually able to acquire the target company. Then, of course, what the target company will do, they'll appoint an advisor. So this advisor will actually be able to advise the key stakeholders or the key parties in the target company. So in this case, what the person they'll be able to advise are, for example, the board of directors and the shareholders of that particular target company. And of course, what this particular advisor will be looking at is the proposal document that has been given by the acquirer. So because in the proposal document, they'll for example, state, once we acquire you as the target company, we'll be able to continue with your business. Or for example, they could actually be able to state, once we acquire you as the target company, we'll actually be able to maintain the human resource. The human resource, for example, in this case, the employees of the target company will be maintained. They'll still actually continue to work as the employees of the target company. So all these proposals in the proposal document will be looked at by the advisor. Then, of course, they'll actually be able to advise the key stakeholders in the target company that this acquisition, these are the advantages it is actually bringing on board. So if there are any disadvantages, he'll likely also be able to advise the key stakeholders in the target company. So what will happen in the target company, the acquisition has to be approved by the key stakeholders who are the members of the company or the shareholders of the company. So they'll be able to get the advice from the advisor. Then, of course, they meet at a general meeting of the company and, of course, pass what we call a special resolution to approve the acquisition. So once they have actually been able to approve that particular acquisition, that particular approval will be presented to the NSE or Nairobi Securities Exchange and the Capital Market Authority. And of course, the other relevant bodies like the Competitive Authority has actually also to be notified of that particular approval. So they'll have to look at it. Once these particular bodies have actually approved of the acquisition, then of course their acquisition can actually happen. And of course, the process of how the two companies will actually be able to integrate is for them to be able to decide either they'll use preservation or which means of basically integration they'll actually be able to use. It is for them to be able to decide. So we normally say that if the acquisition is not actually really friendly, whereby the acquirer is basically forcing things so that maybe the acquisition can actually happen. So in such a case, we say such an acquisition is not actually a friendly one. It is actually a hostile takeover. So there are usually ways of how the target company can actually be able to avoid what we call a hostile takeover, can actually be able to avoid what we call a hostile takeover. So I think we had actually looked at them. For example, what can actually happen, in this case, the target company can actually be able to do a counter offer. What they'll do a counter offer. They'll actually be able to say that as a company, we can actually also be able to acquire you as the ones who are making the proposal to acquire us. So they can do a counter offer. They can actually be able to go for an option of actually having to borrow a lot, such that if the acquirer looks at the books of accounts of the target company, they'll actually be able to fear, because in this case, they'll most probably they'll be acquiring a liability. So wezi nunua kitu yenye iko na madeni. So kwa sababu ukishainunua itabidi wewe utalipa hiyo madeni. So to avoid that, they'll actually be able to shy away. If the target company goes for the option of having to borrow a lot and actually be able to make the acquirer to have that particular fear of having to acquire them as the target company. Another option is whereby they'll actually be able to state that any approval of an acquisition must actually be approved by a special resolution, or at least 75% of the members of the company. And of course, what they know, of course, raising 75% of the members of the company at a meeting might not actually be very, very easy. So if they use that particular option, they can actually be able to avoid what we call a forced takeover. Another option, what they could actually be able to do is to be able to ensure they give high benefits to those employees who are likely to be laid off, or those who will likely be able to be forced, who will be forced to retire once the acquisition has actually happened. So for example, they give them high or hefty send-off packages, because those particular hefty send-off packages will be forced to be paid by the acquiring company. So if they look at that, the acquiring company most probably will fear and say, if that particular bill or that particular wage bill that you are going to take over in terms of the send of packages to those employees who are going to retire as a result of the acquisition is actually very high, then we don't need to acquire the target company, because that particular burden will actually be on us as the acquiring company, as the acquiring company. So those are some of the options that this particular target company can actually be able to use to avoid what we call a hostile takeover. What you do, you can actually just be able to look at the last bits of the notes on this particular topic. You'll be able to understand them. I think we had already gone through them in class also. So it's something I'm just trying to repeat. It's a very common area. They have really tested it. It's like almost 4 times in the past paper. And I think it was tested, I think, in the last sitting also. So I don't think they'll be able to repeat, but it's something you need to be able to understand. You need to be able to understand. So I want us to look at something else. Company accounts and investigations. I think it's topic number 11, just before corporate restructuring. So you can actually be able to write this particular question. The question is from May 2018, question 3. So May 2018. The question says, Roman 1, highlight 4 books of accounts, highlight 4 books of accounts, that a company is required to maintain, that a company is required to maintain, Outline 4 purposes of a profit and loss account. Outline 4 purposes of a profit and loss account. Outline 4 purposes of a profit and loss account. So we can be able to look at some of the books of accounts that are supposed to be maintained by the company. So this one should actually be very easy. So for you in the exams, you don't need to really struggle a lot, because you've learned about them in other units like financial accounting. So it shouldn't actually be very difficult. So you can just be able to mention some of them. So some of them, number 1, statement of financial position, statement of financial position. Statement of financial position. Number 2, statement of income. Statement of income. Statement of income. Number 3, statement of income. Number 3, statement of cash flows. Statement of cash flows. Can be able to mention statement of changes in equity. Statement of changes in equity. Statement of changes in equity. So these are some of the books of accounts that the company will actually be forced to maintain. Then what are the purposes of a profit and loss account? The purposes of a profit and loss account. Why is it important for you if you have a business that you basically prepare what we call a profit and loss account? The first one you can be able to mention, it is the basis for the computation. 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 So you are looking at Roman 2, the purposes of a P&L account or an income statement. It is the basis for the computation of the corporation tax. Just say it is the basis for the computation of the corporation tax. It is the basis for the computation of the corporation tax. It is the basis for the computation of the corporation tax. So that 30% is normally calculated on the profit realized under the profit and loss account. So it is the basis for the computation of the corporation tax. Then the next one, it shows the performance of the company. It shows the performance of the company. It shows the performance of the company in terms of profitability. It shows the performance of the company in terms of profitability. It shows the performance of the company in terms of profitability. It shows the performance of the company in terms of profitability. It shows the performance of the company in terms of profitability. It shows the performance of the company in terms of profitability. It shows the performance of the company in terms of profitability. The next one, it is the basis for the determination of the proposed dividends. It is the basis for the determination of the proposed dividends. It is the basis for the determination of the proposed dividends or distributable profits. It is the basis for the determination of the proposed dividends or distributable profits. It is the basis for the determination of the proposed dividends or the distributable profits or the distributable profits. It is the basis for the determination of the proposed dividends or the distributable profits or the distributable profits. It is the basis for the determination of the proposed dividends or the distributable profits. Then the next one, it shows the profits. It shows the profits or loss realized. It shows the profit 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 or loss realized in a financial year. It shows the profit or loss realized in a financial year. It shows the profit or loss realized in a financial year. It shows the profit or loss realized in a financial year. Then the next one, it enlists all the incomes. It enlists all the incomes and expenses of the company. It enlists all the incomes and expenses of the company. It enlists all the incomes and expenses of the company. It enlists all the incomes and expenses of the company. It enlists all the incomes and expenses of the company. It enlists all the incomes and expenses of the company. And expenses of the company. It enlists all the incomes and expenses of the company. Can list all the incomes and expenses of the company. So we can look at another question. Another question. So it's question 2 of this particular bit. In relation to company investigations, in relation to company investigations, in relation to company investigations, Roman 1, state the powers of an inspector appointed to investigate the affairs of the company, the affairs of the company. Then Roman 2 said the states, state the powers of an inspector appointed to investigate the affairs of the company. Then Roman 2 what are the circumstances? What are the circumstances? What are the circumstances under which the court may appoint an inspector to investigate the affairs of the company, What are the circumstances under which the court may appoint an inspector to investigate the affairs of the company? Roman 3. Outline 4 persons. Outline 4 persons. Or simply say state 4 persons. State 4 persons. State 4 persons. State 4 persons. To whom the court, set 4 persons to whom the court, set 4 persons to whom the court might forward a copy of the report, a copy of the report, a copy of the report made by a company inspector, made by a company inspector, made by a company inspector. So this is from what we call company investigation. So under this particular topic, if you can remember very well, we said that sometimes the affairs of the company can actually be investigated. So when you talk about the affairs of the company being investigated, simply what actually happens in the company is normally investigated. It can be investigated due to certain reasons that maybe the court deems are actually fit for the company to be investigated. So what will happen, the court will appoint a person known as an inspector to be able to investigate the affairs of the company. And we said that when you talk about an investigation, it simply means that all the affairs of the company are being investigated. Anything to do with the company will actually be investigated, from membership, from ownership, from what the company owns, from who are the directors of the company. Everything about the company will actually be investigated. So due to certain reasons, the court can actually be able to appoint an inspector to appoint the court to appoint an inspector to investigate the affairs of the company. So what are the powers of this inspector appointed by the court? So number one, you can be able to say, number one, the powers. So number one, you can be able to say the answer to this one. Number one, the power he has, number one, this inspector, number one, to interrogate any officers of the company, 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 to interrogate any officers of the company. Number two, to investigate the subsidiaries and co-subsidiaries of the company, to investigate the subsidiaries and co-subsidiaries of the company, to investigate the subsidiary and co-subsidiaries of the company, to investigate the subsidiary and co-subsidiary of the company, to investigate the subsidiary and co-subsidiaries of the company. Number three, to apply to the courts, to apply to the courts for attendance, to apply to the courts for attendance and examination, to apply to the courts for attendance, to apply to the courts for attendance and examination on oath of any person, and examination on oath of any person he would not otherwise be entitled to examine, to apply to the courts for attendance and examination on oath of any person he would not otherwise be entitled to examine, to apply to the court for attendance and examination on oath of any person he would not otherwise be entitled to examine. Then the last one, you can actually be able to say, to make a written report, to prepare or make a written report to the court, to prepare or make a written report to the court, to prepare or make a written report to the court, to prepare or make a written report to the court, to prepare and make a written report to the court. Prepare and make a written report to the court. Then the next one, what are the circumstances under which the court may appoint an inspector to investigate the affairs of the company. So those are the reasons as the court will be able to look at and say, these reasons are actually quite enough evidence for us to be able to appoint an inspector to investigate the affairs of the company. Number one reason, where the company is being conducted with the intention to defraud the company's creditors, where the company is being conducted with the intention to defraud the company's creditors, where the company is being conducted with the intention to defraud the company's creditors, where the company is being conducted with the intention to defraud the company's creditors. Number two, if the company was formed for fraudulent or unlawful purpose. If the company was formed for fraudulent or unlawful purpose. If the company was formed for fraudulent or unlawful purpose. If the company was formed for fraudulent or unlawful purpose The next one. If it is in the public interest, that the affairs of the company be investigated. So there's a public interest. The public has an interest that the affairs of the company be investigated. So that could be a reason the court can actually be able to look at and say it is quite enough evidence for an inspector to be appointed to investigate the affairs of the company. So you're saying number three, if it is in the public interest, that the affairs of the company be investigated. If it is in the public interest that the affairs of the company be investigated. If it is in the public interest that the affairs of the company be investigated. If it is in the public interest that the affairs of the company be investigated. Then the next one, or maybe the last one, if the company members have not been given, all the information with respect to the affairs of the company. If the company members have not been given all the information with respect to the affairs of the company. If the members of the company, or if the company members have not been given all the information with respect to the affairs of the company. So if the directors, for example, are denying the members certain information, then the members can actually be able to apply for what we call inspection of the affairs of the company. So if the company members have not been given all the information with respect to the affairs of the company, So those are the reasons that can actually be able to make the court decide that the affairs of the company be investigated. Then this last one, state 4 persons to whom the court might forward a copy of the report made by the company inspector. So at the end of the investigations, what will happen, this particular inspector appointed by the court will be able to prepare a report and basically hand it over to the court. So the other parties will be entitled to this particular report. So who are the parties, or who are the persons who will be entitled to the report prepared by the inspector appointed by the court? So number one, the other persons, we have the company itself. So you can have the company itself. The company itself will be entitled to the reports. The company itself. We have the company itself. The next person, the registrar of companies, the registrar of companies, the registrar of companies, the registrar of companies, the registrar of companies. Then we have members of the company. We have members of the company. Members of the company. Number 4, any body corporates or individual mentioned in the report. Any body corporate, or individual mentioned in the report. So maybe there's someone who has been mentioned to have done a wrong in the company. He has a right to get the report so that he can prepare defense, his own defense, once the case is actually put forward or basically handed over to the prosecutor. So then the last one, to the applicants who applied for the investigation, to the applicants who applied for the investigation, to the applicants who applied for the investigation, So to the applicants who applied for the investigation. So the persons who can actually be able to apply for investigation, we can have the company itself. So through maybe a resolution by the members of the company. You can have the Attorney General in case of public interest. So sometimes they could ask who are the parties who can actually be able to apply to the court. Remember, the courts won't just appoint an inspector. They must actually be able, you must actually be able to have someone having to apply to the court. And this person will actually be able to apply to the court by using these particular reasons we've given here under number 2. So maybe the company is being carried out with the intention to defraud the creditors. So a person seems this is a good reason I can be able to use to basically convince the court to appoint an inspector. So you can have the company itself, or maybe the company itself, basically through an approval or basically a resolution by the members of the company. You can actually be able to have maybe the Attorney General. So the Attorney General can actually be able to also be able to apply for the affairs of the company to be investigated, especially if it's in the case of the public interest. If it's in the case of the public interest that the affairs of the company be investigated, that the affairs of the company be investigated. So you can actually be able to apply to the court for the affairs of the company to be investigated. So I think that was most of the bits that we learned under what we call investigations under company law. So it's actually also a very common area, this particular area of investigations. So most probably you get like one question there. So they could test one question there. So it's something you need to be able to understand what normally actually happens under company investigations, So maybe let me take a break of like 1 minute, then I think we can look at shares. I think We have like around 40 minutes to end the class. So I think we'll have done some bit of shares. Nzuri sana. Wow. So under the topic of shares, I think we learned about the classes of shares, classes of shares. Classes of shares, we have classes of shares, we have transfer and transmission of shares, transfer and transmission of shares. We have what we call mortgaging of shares. Mortgaging of shares. We have classes of shares, transfer and transmission of shares. We have something about lien on shares. Lien on shares. So these are some of the areas we looked at under the topic of shares, under the topic of shares. So when you talk about a share, so we were able to define what is actually a share in a company. It is the unit into which the share capital of the company is divided into. Or alternatively, we could actually be able to say a share is simply a right to the profits of the company. Because if you have shares of the company, you'll be entitled to get dividends. You'll be entitled to get what we call dividends from the company. And this one is normally gotten from the profits of the company, or basically the distributable profits of the company. So if you have shares in the company, you'll be entitled to part of the profits of the company in form of dividends. So when you talk about a share, you can be able to say it is simply the right for you to be able to get part of the profits of the company in form of what we call dividends. Or you can be able to say it is a unit into which the share capital of the company is actually divided into. So when you talk about classes of shares, are the types of shares we can actually be able to have in a company. For example, you can be able to talk about ordinary shares. You can be able to talk about preference shares. You can be able to talk about redeemable preference shares. Redeemable preference shares. You can be able to talk about employee shares. You can talk about founders shares. You can be able to talk about bonus shares. Bonus shares. So ordinary shares, so these are, sometimes we call them equity shares. So the holders of these shares carry the main risk of the business. So they are the ones who will be entitled to the remains of the company after payment of all the other expenses and other shareholders in case the company is to be liquidated. They are the ones who will be able to vote or determine on the matters of the company, maybe at the general meeting or the annual general meeting of the company. So they carry the main risk of the business of the company, the holders of these particular shares. Preference shares, these ones, they get what we call preferential treatment in the company. They get dividends before any other class. So they get what we call preferential treatment. They get dividends before even the ordinary shareholders. So they'll be entitled to the dividends of the company before even payment of dividends to the ordinary shares of the company. They'll also get preferential treatment in terms of if the company is to be liquidated, they'll be paid first before the ordinary shares. So that is part of the rights that the holders of these shares will actually be able to enjoy. They get their dividends at what we call specified rates. So the rates of dividends in the company in terms of how much they're supposed to get dividends is normally actually at specified rates. The rates are actually already specified. So it's not like the ordinary shareholders will be entitled to maybe the profits depending on what has been proposed by the directors of the company. Redeemable preference shares, these are the ones the company will actually be able to redeem or buy back depending on the agreement with the holders of those particular shares. So maybe after 2 years or maybe 3 years, the shares will be redeemed. So when you buy the shares, you as a shareholder, you pay money to the company. So what will happen at the end of the 3rd year, basically the company will give you back the money and basically you give the shares to to the company. So the company is actually able to redeem the shares. The company is actually able to redeem or buy back the shares. Employee shares, so these simply shares that can actually be given to the employees of the company in terms of maybe having performed so well, or maybe having served the company so well on retirement. You can be given some shares in the company. Founder shares, so these are the ones given to the promoters of the company. So we say the promoters, one of the ways they can be remunerated is basically having to be given some free shares in the company. So they can be termed as being the founders shares. Bonus shares, the company opts to pay dividends in terms of shares. So instead of having to give out dividends or pay out dividends, the holders of the dividends, or the ones supposed to get the dividends, would be entitled to extra shares in the company. So those shares will be termed as being the bonus shares. Those are some of the classes of shares that you can actually be able to have in a company. So there are a few things we learned about shares. So we talked about, for example, mortgaging of shares. So mortgaging of shares is simply whereby you use your shares as a form of security to, for example, acquire some form of lending or money from a lender, maybe a financial institution like a bank, or maybe a SACCO. So what you simply do, you present your share certificate, because once you acquire the shares, you'll be given a share certificate that you can be able to present as a form of security to the lender, and you can actually be able to give you a loan. So if you do such, we say you're actually mortgaging your shares. So there are two options of how it can be done. We can have what we call legal mortgaging of shares, and number two, we can have what we call equitable mortgaging of shares, equitable mortgaging of shares. So under legal mortgaging of shares, what will happen is that there's usually what we call complete transfer of the shares to the lender, until when the borrower or maybe the shareholder is able to dispense off with the loan, is when now the shares will revert back to the owner of these particular shares. So in this case, for example, if you acquire a loan from a bank, under legal mortgaging, what will happen during that particular period you are paying the loan, the shares will be in the ownership or in the name of the bank. So the bank becomes like a member of the company until when you'll be able to pay the loan. That's when the bank will give you back the shares. So under legal mortgaging, there's actually complete transfer of the shares to the lender until when the borrower is actually able to dispense off with the loan. That's when the shares will revert back to the owner of the shares, or when the shareholder will now actually rightfully get back his shares. Under equitable mortgaging, what actually happens here, the chances are actually 50-50. You have 50-50 chances, because in this case, the shares are not completely transferred to the bank. Unless maybe you default, you as a borrower, or maybe as a shareholder, that's when the bank can actually be able to take a step to take over the shares, or to take over the shares from you as the borrower. So in this case, under equitable mortgaging, there's no complete transfer of the shares until maybe when the borrower defaults on payment. That's when the bank or the lender can be able to take a step to be able to acquire the share. So there are usually two parties. We have the mortgager. The mortgager is the borrower, and you have the mortgagee. The mortgagee is the lender. So we are saying mortgaging of shares. It is simply where a shareholder can be able to use his shares as a form of security to get a loan, or to acquire a loan from a lender, maybe like a bank or maybe a SACCO. If such happens, we say the shares have actually been mortgaged. So therefore, the borrower, or basically the shareholder, is actually the mortgager, and the lender, or the other side, the bank, is actually the mortgagee. So under legal, we are saying there's complete transfer of the shares until when the loan is actually paid. So that one, we call it legal mortgaging. Equitable mortgaging, there's no complete transfer of the shares unless maybe the borrower defaults, or maybe the mortgager defaults on payment of the loan. That's when basically this particular lender can be able to take a step to be able to take over the shares, So shares can actually be used as a form of security to acquire a loan. So maybe they could bring a scenario talking about a particular person having shares maybe worth 6 million in a particular company. So he wants to get a financing from a financial institution. Then they simply ask you to advise this particular party as to whether he can actually be able to use his shares as a form of security. So you simply state that, yes, this particular person can be able to use the shares and therefore you can be able to do so under two ways, under either legal mortgaging or equitable mortgaging. We have what we call lien on shares. So lien on shares, I think I've explained it previously. So lien on shares is simply whereby, for example, if you are a shareholder in a company and the articles of association of that particular company or the rules governing the internal affairs of that particular company actually allow the company to be able to take over the shares or your shares in case you are indebted to the company, in case you're actually indebted to the company. For example, in this case, we could actually be able to talk about you are like maybe the customer to the company. You acquire particular products from the company on credit. And also, you are also the shareholder in the same company. So it simply means that you as a customer, if you fail to make the payments of the products acquired from the company can actually be able to exercise what we call lien on shares if the articles allow. What it simply means, the company can be able to withhold your shares until you're actually able maybe to pay off the amount. If you fail to pay off the amount, then the company can be able to take over the shares and maybe sell them to another party to be able to recover the money you owe to the company. If they do such, we say the company is exercising what we call lien on shares. Is exercising what we call lien on shares. We have transfer and transmission. So transfer is simply whereby we have two parties. So you have the transferor and the transferee. The transferor is the one transferring the shares to the transferee. So the shares can actually also be transferred. So they are movable assets. So it can simply actually be transferred from one person to another. So the two parties normally involved is actually the transferor and the transferee. So there's usually an instrument that is normally used to transfer the shares. We have the share transfer form. So in the share transfer form, part of the contents, they could ask, what are the contents in the share transfer form? What will be contained in the share transfer form is, of course, you have to find the name of the company under which the shares are being transferred. You'll have the details, or basically the name and address of the transferor. You'll have the name and address of the transferee. You'll have the consideration paid for these particular shares, what was actually paid, how much was actually paid to acquire the shares by the transferee. Then, of course, it will be signed by the transferor, must actually be able to sign. And also the transferee should actually also be able to sign. So since it is the document forming the agreement between the transferor and the transferee in terms of transferring the shares, then of course it has also to be signed by both parties. So once it has been signed, it can be presented to the company. Once it has actually been approved, then the previous share certificate of the transferor can be cancelled out. Then they prepare a new share certificate in the name of the transferee. And therefore the transferee will become the member of the company, while the transferor loses membership of the company, of the company. Transmission of shares, it is simply whereby we have, for example, in case of death, in case of bankruptcy, in case of receivership of a member, the shares will likely be taken over. The shares will likely be taken over by, in this case, for example, the beneficiary or maybe the receiver, or maybe also it could be in the case of maybe insanity, or a member has been declared to be insane, the shares will be transferred to the beneficiary. So if they do such, we say the shares have been transmitted. That is what we mean by transmission of shares. That is what we mean by transmission of shares. So I think I'll be able to end there. So that's what you need to be able to know about shares. So I think I've done my bit. I've done my best since we started the semester. So I hope those who have been following, so you've been able to gather a lot. So what I can do maybe is to wish you the best in the exam or the forthcoming exam. But in case of any query, you can always ask. You can always ask before the exam. But of course, I've repeated severally myself. I've told you, be keen with the topic of formation of companies. It's the most tested topic in the exam. I've shared questions and answers on shares, debt capital, share capital, up to this particular point, because I shared it a while ago. You must have already gone through these particular questions and answers. I've shared some model papers. So some model papers which I shared, they have the questions and some of them have the answers. We've gone through the blocks since we started, through several questions in the class. Hope you've gone through the questions again, you've revised. I think I've also mentioned a few case laws that you need to be very keen with. Hope you've been able to go through them and remind yourself. We've talked about the rule in Solomon versus Solomon and Company Limited. We talked about the rule in Trevor versus Whitworth and its exceptions. We've talked about, for example, the rule in Royal British Bank versus Tarquins. So hope you've been able to go through it. We've talked about the majority rule. So there are like 5 of them, the majority rule and its exceptions. We've also talked about these other one under meetings, the rule in Sharp versus Dawes and its exceptions. Hope you've actually been able to also go through those particular case laws. And in case of any challenge, you can always reach out to me. I'll be able to assist. So with that, we've come to the end of this particular semester. I wish you all the best in the exam. So we'll meet maybe elsewhere or on another forum. So thank you very much. You can have a good afternoon.